Welcome to Investing in Startups. I'm Joe Maker. We're trying something new this week with our first three-person conversation. Our guests are Sonia Nagar from SNAK Venture Partners and Colin Gardiner from Yonder Ventures. Sonia and Colin are both early-stage investors, friends of mine, and experts on marketplaces and network effects. We talked about AI's role in marketplaces, why network effects aren't more popular, even though they should be, how to make your own luck, what it's like to raise your first venture fund, and more. I hope you enjoy, and thanks for listening. Sonia Collins, great to have you here on the show.
Thanks for having us.
Great to have us. Who goes first?
Yeah. Well, this should be fun. It's first time doing a multi-person show, and I think it'll be more interesting. And I thought I'd get together two friends of mine who are really smart and experts in the same domain, which is, we'll call it marketplaces, but network effects more at large, both early stage. And I love talking to both of you, and I thought it'd be just a really fun conversation. And I will add something else, is that I have founders all the time, particularly ones building something around marketplaces, network effects, who say to me at the beginning of a meeting, hey, it's great to talk to you. I listened to your show. I listened to your interviews with Colin and Sonia beforehand. I'm like, okay, cool. So here we are. Thanks for coming on, and this should be fun. I thought a good place to start, high level, end of year, would be talk about the state of the venture market. It was really two-speed this year. Crunchbase reports AI native deals were up 75% through the first 3 quarters of the year. We're talking dollar funding. Non-AI deals were down by 13%. And Sonia, curious, does that line up with what you see on the ground day to day?
Yeah, that tracks. It does feel like it's a tale of two cities. And for folks that are building digital marketplaces, especially in legacy industries, which is where my fund SNAK Venture Partners is focused, we're not seeing a ton of competition for deals. Part of that is because we are thesis driven. So we do some outbound work and find companies and categories we're interested in who may or may not be fundraising. But even for the folks who are actively fundraising, our average post money at the seed stage, which is we are not pre-seed. Colin is our counterpart on the pre-seed side. We play at the seed stage. Our average post money has been at 12 and a half post. So a far cry from my folks, my friends in Silicon Valley that are doing AI deals are telling me that their seed stage deals are landing at like 50 to 100 million pre-monies with either no revenue or very little revenue, which is interesting. Feels like the lessons of 2021 were not learned, and there's some categories where like mistakes are being repeated all over again.
I've had a lot of mixed thoughts about this. I do think what's different than, let's say like the COVID era piece of this is that there are actual companies that are growing faster than anything we've ever seen before. And I think part of what you're seeing there, I don't know, maybe it's the economist in me. It's like the lemon theory of cars, right? Why does the value of a car drop when it leaves the lots? Because the average car is going to break down somewhere in there. And so all the cars have to lose value. And I kind of view it as the flip side here is that basically, if you look at all the probability of a really outsized outcome has gone up essentially within the AI companies. And so, yes, then if the expected value goes up, then the entry point valuations will go up because people think the expected value goes up. That's kind of been how I've been rationalizing it. I'm not saying I want to pay those valuations or you can make the fun math work, but it is kind of like at least my underlying theory behind why it is. But I've definitely had to change strategy around it. Like Sonia said, I'm pre-seed, I guess, specialist at this point and even try to do before that. And if you try to go 10 million posts and under, it really like caps what you can invest in. And so that means for me is that like I'm going as like close to idea or getting to know the people as early as possible and having to probably take a bit more risk on the execution side to try and get into valuations that essentially I can make the math work on. So I think that's just something to be aware of and what I'm seeing.
We all like marketplaces, more broadly, startups with network effects. A lot of investors don't. Everyone loves SaaS. I looked at this stat last year where the amount of money that went into SaaS deals at early stage was 17x what it was for marketplaces. Why don't more investors like them? Like Colin, when you talk to people about marketplaces, what is the reason that they shy away? And when you tell them you're a pre-seed marketplace expert, they look down at their drink and try and excuse themselves and go to the bathroom at the cocktail party.
I don't think anyone actually has like a fundamental critique that lands. I don't think anyone's saying, oh, that business model's dead, because if we look since the dawn of time, like how does commerce happen? We match supply and demand and find a price, right? And so I think a lot of what people are saying when they don't like marketplaces is that they don't think that there's a lot of new venues that can pop up, right? They think of like Airbnb, Uber type time frame where it was really like, hey, how do we take latent and fallow inventory and put it on the internet so that's essentially transactable? And I think that paradigm is shifting. B2B category definitely still can happen there. I think that the B2B category is probably, I don't know, a decade behind the consumer side from that perspective. But if you flip over and look at the consumer side, I think it just looks very different. And the surface areas of where the marketplaces will happen are just different. They're not focused on taking real assets that are essentially being underutilized and putting them online. I think they're more now around digital assets. I think there's a lot of these, what I'm calling Gen Z native marketplaces that are like really blown out of the water. WAP just announced their numbers. They're doing like 2 billion in gross transaction value, which is insane. And, they're just more digitally native. So I just think what it looks like is different. And if you are looking at the past and expecting those things to happen, yeah, of course, those aren't going to happen anymore. So it just looks different. Is all the way I look at it.
Yeah, and I think that later stage investors, everybody loves a marketplace that's proven out, that's at scale. At the earlier stages, marketplaces are harder to build. You've got to build both supply and demand at the same time. Historically, it took longer for that ramp to happen. So in this like instant gratification, some AI startups are ramping to 10 million in revenues, seemingly overnight. It's harder in marketplaces, especially if you're still working in real assets versus digital. I think digital marketplaces can scale at hyper speed, similar to all these AI startups. And I think people got burned out of the Uber for everything that happened in consumer, where there was a misunderstanding that like there could be all these niches that were already covered by incumbent marketplaces that were digital. I think a lot of people made bets on some niche categories and the Uber of everything and got burned. And so now there's a bunch of people who've fallen out of consumer in general and then consumer marketplaces as well.
Colin, what do you think it'll take for marketplaces to come back in vogue again?
I kind of hope they don't come back in vogue for a while and that we can all quietly
long enough for you to deploy first couple of funds.
and then fund one.
Then they become red hot.
That would be great for all of us. Look, I think things start from a builder perspective rather than an investor perspective. And I think there has to be intrinsic interest on the build side to go after these things. I don't think you have that like as a general like core of like founders are not focused on those types of businesses right now. And I think that will eventually happen. There's always kind of like this like vanguard, these early folks that do it. People see that success and then they go, like there's this new blueprint that I essentially can apply to a bunch of different things. Let me go do those things. So I think Mercor somewhat is starting to kind of open that up. I think AI, there's a lot of AI labor marketplaces that are doing quite well. Micro One in your portfolio, Joe.
Whoop.
But I think there's like this longer tail of what I'd call AI native labor marketplaces that are starting to pop up, where it's very clear that like labor marketplaces were actually very hard to do at venture scale, I think before AI. And now all of a sudden, they're actually really opened up this category that really wasn't a darling before that. And so I'm starting to see just a ton of applications of that pop up. So I do see founders going into those areas, and I think you'll see some big outcomes there. They just haven't happened yet. And then there's going to be more trickle down into other areas. But I think you need like that first kind of company to go out and kind of prove the way. And then that really kind of unlocks a lot more founder interest.
Yeah, I'm hopeful that Equipment Share is rumored to be exploring an IPO. If they go public, that will create some positive vibes around B2B marketplaces. Fair eventually will exit or go public, which will be a great outcome. And then there's some traditional like big IPOs, like Medline just filed their S1. And while they're effectively a distributor, old school marketplace in a traditional industry that has yet to be disrupted, but money is being made in these marketplaces. And to Colin's point, when people see that, will inspire some builders to hopefully more builders to start building.
I want to play startup therapy about a portfolio company I've got that I want to hear your opinions on. So marketplace, clear product market fit. I'd say they have a leading position at a very large market. They haven't started charging a take rate on the marketplace. They're monetizing other ways, partly because customers are price sensitive in this market and they're conscious of not rocking the boat. They're thinking instead about routes to monetize. Do you think going with other, and maybe start with Sonia, do you think going with other angles makes sense? Or should they just kick the door down and charge a lower take rate to get rolling?
Yeah. So I actually am going to take some inspiration from one of Colin's posts where he talked about SaaS enabled marketplaces. I think the beauty of you're creating value in a marketplace and matching supply and demand. There are a ton of different ways to monetize. We at Pritzker Group, I invested in a company called Fuel Me that was in the fuel distribution space. And they have various segments of customers, data centers who are price insensitive that they can take a really high take rate on. And then they have fleet, like car fleets for companies with delivery. And those folks are super price sensitive around procurement of fuel and not wanting to add even pennies on, to what they're paying. And so they have a different strategy for different segments where for the folks that are price insensitive, they can take a take rate. For the folks that are price sensitive, they have a SaaS revenue, a different model. And they found customer on the procurement side, folks are more than happy to pay. But you can either monetize via take rate, you can monetize via SaaS, you can monetize via ad revenue, figure out how to monetize the vendor side. So the beauty of marketplaces is it's not always just take rate. If you're creating value, you can monetize in a bunch of different ways.
Colin, can you join our therapy circle?
Yeah, I mean, I think Sonia said I have one investment that has had a similar playbook, and they've really kind of gone only SaaS, and I think it's gone well for them. I'd say the big problem, though, longer term is that the real value is in the transactions, right, and then the GMV. And so I always suggest to people that you do it as early as possible, and that even if it's lower than you want it to be, at least you've set the standard and you can go out to market that way. Because I find it very hard to do it later. It'll be very painful. And it's actually easier to raise prices on things than it is to go from zero to an actual price. So my suggestion is always do it early and often because it also is a good indicator of product market fit. Like, do you actually do people actually value your marketplace for that quality? And so I'm not actually super familiar with anyone that's gone a long time without a GMV take rate and gotten to big scale. I think that maybe that's a good case study there. Seems doable, but my personal advice to them would be to do it sooner rather than later, just to really have some intellectual honesty about, can you monetize that?
I find a lot of founders at early stage are desperate to get subscription revenue because they have enough conversations with VCs who are like, we love SaaS. And we all love recurring revenue. Everybody likes recurring revenue. Yay. But they'll hear, we don't love transaction based as much, not really seeing the whole picture with, a network effect around it and not appreciating that it's really about the consistency of the individual transactions rather than inherently sticky customers. It's the aggregation of all these transactions and the gravity that brings it all together. So I see a lot of marketplace founders, or I've even seen social network pitches where they're like, yeah, we're doing a subscription model. And I'm like, why? And like, well, VCs are telling us that's what they want to see. And I'm like, I wish you good fortune and the worst to come. Sonia, what's something you changed your mind about in 2025?
AI has definitely changed my mind on quite a few things. One, and this might be a little controversial, is for B2B marketplaces, I feel like the most important quality for a founder is their domain expertise and having the relationships to bootstrap and get an idea off the ground. The technical co-founder piece with AI tools making it so easy to vibe code something into existence, I have put a little bit less emphasis on, at least at the seed stage. And I'd say so far majority of our founders have had really strong technical teams, but it feels like to go from 0 to even 20 million in GMV, the technology that you need in the market, you need to build AI into your tools and your processes, but you're not building developer tools or inventing new LLM models. And the tools for AI coding have gotten so good, you could do a lot there. And then the second thing is more on historically, a lot of the marketplaces we've invested in have been supply first. They've started with supply and then figured out a way to market to get demand. And with AI, we're seeing you can now sometimes synthetically create supply or start with demand and then use AI agents to efficiently go out and procure supply, which is just an interesting pivot on like, I think 95% of the marketplaces I invested in prior to 2005 or 4 were all supply first. And that's no longer the case, or doesn't have to be.
Yeah, I have some thoughts on that. I think in the traditional model has always kind of been this demand side pick model where essentially the supply side puts up an ad and then the demand browses at their leisure to find something, right? And I think to your point, paradigm wise, and I think this may be more specific to B2B because of this seems to be in like a lot of markets, a lot of like long tail, like wholesalers or, just different kind of sellers of like whatever it might be, that it makes more sense to get the demand and then to go shop it like as a workflow rather than the other way around in like consumer type businesses. So I definitely seeing that. I think the thing I get, or at least I have a question mark about over a long run is like, if it becomes easy for everyone to do agents to do those things, like does that opportunity essentially wash out on margin, right? Because it's price discovery becomes easier and easier.
Can you expand on that for folks?
Yeah, I think there's many different applications of this, but I think there's a few companies out there. Just to give you an example of one that's real, like Hello Gravel. They're in the aggregate space. They, essentially they do consumer and B2B. But so you come in, you say, hey, I need gravel for my yard or my driveway or whatever it is. They go out and essentially find you quotes for it and bring it back and do all, essentially handle all the shoe leather costs of searching for you. And so I think those things are really interesting right now because one, they can go across a bunch of different providers, find the best pricing, all of that. But I think what happens is you have these agents where it drives the cost of searching down to zero and they become more available. It's going to become harder to compete in that and make margin. And so that's where I think about these businesses a lot is like, where does the margin compression go over time and like what defensibility? And so I still really always come back to this, like, can you have like unique supply that people can't find anywhere else? Because if you can, you have defensibility. Whereas if you work in these commodity markets, you have to like operate on a couple different vectors to be like really great. You have to probably offer the best customer support, have the most scale so that you can get the margins to work, or you got to offer other like liquidity services around whether it's delivery or logistics or things like that. So I think as you get into those things, if you're building those types of business, you just got to know the game you're going to play long term. That like, back to your startup therapy, Joe, that might be a market where your GMV take actually goes to zero, not because you don't want to charge a take rate, but because that's how like price transparency will work and that you actually make your money on a bunch of other services. So just my food for thought on those ones.
I use agents for shopping. Anytime I do a transaction now online, let's call it more than like $100, I'll take 2 minutes. I'll go to my agent and be like, try like 15 different coupon codes for this basket and see if you can save some extra money. And usually they'll succeed in that.
I have a bigger theory that I'll put out there of like where we're going to go. And, look, this is probably way early and it'll take way longer for this change to happen than expected. But I think websites in general are going to like relatively just die. I don't think as a medium that they actually make as much sense in the AI world. They're going to be around for a while. Don't get me wrong. But I don't think people are going to use them as much. And so what does that mean for a marketplace that has spent so much time building out this search UI where demand side can come in and like search for things or vice versa? It means that most people are going to do that searching with an AI chat or with an AI browser, kind of like you're saying, Joe, like, hey, I'm already telling it what I want and it's going to go find the things and do the search for me. What that means is that who wins in those contexts is the most legible to the LLM companies, right? Like if you are not visible to them, you will not get picked up. And so your great price or discount or whatever it might be won't get shown. And so you won't win. And so what I'm thinking longer term is that the companies that are really going to win are the ones that are going to be able to bring their supply online in a way that is like really LLM legible. And it makes all of their offerings really LLM legible. But I mean, that's essentially the theory behind it. How that plays out, I don't know exactly and what time frame, but I already see it happening.
You both closed on first funds this year. Sonia, what advice would you have for investors, potential emerging managers out there who are thinking about taking the plunge and starting their own firm?
We definitely benefited from having an anchor investor that we had known. Both my partner and I worked at Pritzker Group Venture Capital for the Pritzker family, him for 19 years, me for almost 9. And so having them as an anchor greatly expedited and improved our fundraising process. I think one thing I wish I had known earlier was just how long it takes to build relationships with new investors. And so because of the way we were transitioning out of a firm and starting our new firm, and there we wanted to be family wanted us to be a little bit private about what we were doing until we officially left. We didn't have a warm-up period, but if I knew that I was going to be raising a fund 2 years ago, I feel like give yourself a year where you're not fundraising to just go meet as many people with no pressure as possible that could be a good fit for your fund. And then the first mover, you having an anchor and then finding the people who are founders who are thesis aligned with your fund. Those were always the people that got it and were fast commits. And even though they were smaller checks, they gave us a lot of credibility going into later closes. So those are the things that I think can help speed up a very painful fundraising process and hopefully help you hit your target faster. Because it's still hard. LPs have not had liquidity, and so venture is not super popular still.
I did not have an anchor LP, other than, I guess, myself. I largely agree with Sonia that the makings of a fund are years in advance, and you have to lay a lot of groundwork. And that if you haven't been laying that groundwork, it'll be very, very difficult. And maybe you get lucky and you get a fund of funds or someone notable in that wants to take that flyer or likes your look, so to speak. And that will be your anchor and that'll make it happen. But I think if you don't get that track and you're not a spin out from like a big name fund, it's going to be trench warfare, just reaching out to people. That's 100% what it is. I think a lot of people waste time on their first fund talking to the wrong people.
I did.
But you should recognize there's so many great people to talk to, but they're just not a fit right now. And like just recognizing that, yes, you should talk to them, but they're a fund too, and don't get emotionally invested in them ever investing in your fund one is really important. But get that introduction, talk to them, impress them, keep them up to date, come back for fund two. Don't think they're coming into fund one. And your fund one largely is going to be the people that believe in you, people that you've made money for, people that believe or did what you're investing in already, and then essentially are going to be referrals from other people. And those are kind of the buckets. The checks will probably be smaller than you expect for your first fund and will be a lot harder to get than you think if you're not spinning out of a fund. I just want to caveat that. Like, yeah, if you spin out of a big fund or just a well-known fund, then I think there's a whole different kind of category. But for someone like me that didn't and really comes more from the operator side and it's like, hey, I think I have good pedigree and experience doing that. You don't actually have a lot of investing kind of pedigree. And so, people have a lot of questions about your ability to pick and things like that. So my suggestion to people, if I just wrap it up, is like, if you have made people money before and had picked some winners before, you're going to make your life a lot easier. And I would start a year or two in advance networking before you go make the ask.
Yeah, that's great advice. Colin, I tell people that line of yours about it's really hard to raise a fund if you haven't made money for people before, either as an operator or VC. I think that's totally true. And, even in my case for Fund 1, I had 31 LPs. 18 of them were former colleagues. 12 of them were people I'd made money for before who I didn't work with. And 31 was the brother of a former colleague. So it's just incredibly tight. The number of first degree connections for Fund 1, that's going to be the reality of it. And, as Sonia was saying, the longer you can let it cook for on building relationships in advance of that really goes a long way. In a way, I think a lot of podcasts kind of lead emerging managers into having unrealistic expectations, which may sound funny because I'm hosting a show. But what can happen is the people who end up as guests on these shows are the people who successfully raised the fund, right? They're people that had made money for others before. They ran a good process. They went through the trench warfare and they made it out the other side. And then usually by the time they make it to fund 2, they got there because they did all those things. Plus they had promising early performance. So if you're listening to an emerging managers on fund 2 or 3, you're like, oh, well, I'll just land some money from a fund of funds or an anchor. You're like, well, why didn't I think of that? I'll just get a billionaire to invest in my fund. It's like, well, it's because, Sonia worked with this person for many years, built a lot of trust and relationships, and they were able to make that happen. Or, a fund of funds could be a similar story. And yeah, I think the advice you both gave was very good and pragmatic, and like not very satisfying probably for some people who just spontaneously are like,
Yeah.
I want to become a venture capitalist. It's like, all right, well, if you haven't made money for people before, you might find that to be pretty tricky.
It's like that Elon quote, like, people are surprised when I tell them I work like 24/7, 52 weeks out of the year, and then they call me lucky. And that's like what fundraising is. And like the other thing that people don't think about with the fund is that they're very distinct jobs. Investing, fundraising, and like managing are like, they're different. They're not the same skill set. They have overlaps and synergy between them, but they are not the same thing. And they're very difficult, all three of them separately. And so I think what people really underweight is like how much hustle is required to do this. Like just straight up hustle, ingenuity. Like some of the best people I know at fundraising are just like dogged in their like outreach, in their like follow up, in their like social engineering. It is like an art, and it is like art plus brute force. And I see them, I appreciate what they're doing, and I aspire to be as good at them as what they do. But if you are not amazing at those things, I think you're really going to struggle to fundraise.
Yesterday, I was putting together a floor for a home gym. It's this project we've been working on for a while. And my son and I are putting together these tiles. It was extremely tedious. My thumbs hurt from doing it today. And you had to put together these interlocking puzzle pieces for each tile. And there were 32 tiles. It took us a couple of hours. And Jack, at some point, was like, Papa, look at this technique. Let me show you how I'm doing this. And he had come up with a better technique than I was doing. And he's like, Pop, you got to work smarter, not harder. And I'm like, all right, first of all, it's humbling when your 11-year-old said this to you. But setting that aside, I was like, look, what you said is true, but I want you to know that I've never met a person who was super successful who didn't work their ass off and work very, very hard. They were smart too, and they tried to work smart. But people who say things like work smarter, not harder, they're usually not the people who build anything of substance. But by the way, if anyone out there needs an 11-year-old to assemble flooring for your home gym, my son he's very good. He's very efficient. Sonia, what are you looking forward to in 2026?
Well, we will be technically done fundraising because we'll have done our final close, although you're never really, it's same as, we give our advice to founders, you're never really done fundraising. So there's a certain percent of my time I'll always be spending talking to LPs, but the majority of my time will be working with portfolio companies and founders. And I'm excited. To do that.
I echo what Sonia said on that. I'm closing here in like a month and very ready for that, but also know at the same time, it's like, yeah, it's over for this one, but there's the infinite game of funds. And so just mentally preparing for the next one on that. But I'm excited to deploy for, and really be focused on that for a period of time.
Colin, what's a conventional view in venture right now that you think is bullshit?
Well, we've got a lot. I think the one thing I think about through fundraising that I've learned a lot about is I think this like fund to fund dynamic on what the downstream venture funds look like is not talked about a lot. I think a lot of first time fund managers are going out and doing these like 15 to 30 companies funds that might be considered more concentrated because there are a lot of people talking about that's what they want. And I think, for example, like fund to funds, they're creating like this highly diversified portfolio. If you like view it as a look through, they're going to do a bunch of funds. I don't know exactly how many they do, but let's say it's 10 funds, 30 companies each. They're doing 300 companies. They're making a diversified portfolio. And I think one of the things that doesn't get talked about a lot is that probably as a first time manager or like, just someone doing a fund, you're probably better off taking more bets than less bets as you hone in on what you're doing. And so what I see is that there's not very many funds, especially first time funds, that do a lot of companies. And by a lot, I mean 50 plus in their portfolio. And I think that is something that is unconventional and something I've run into as I like fundraise for a fund that is more highly diversified. It's like a very incongruent conversation. So that's something I think about a lot and beating the drum on is that I think most people are not good at picking. I'm going to say it out loud. Maybe that is, I think venture capitals fancy themselves pickers. I don't think most of them are good at it. And it ends up being luck masquerading as skill. And I think you actually want to be probably the best sourcer you can be out there. And that is going to give you the best surface area for real luck to hit. That's my 2 cents, unconventional takes for the day.
Sonia, how about you?
I mean, we definitely have a similar philosophy at SNAK about making our own luck. Like, you can't do the best deals unless you see the best deals. So while there is an element of luck in this job, you cannot deny you can make your own luck by increasing your surface area. My more controversial take is on vertical SaaS. I feel like I don't understand investing in vertical SaaS today with AI making it so easy to copy and build software. It's like software without network effects feels like a doomed, like over time, a lot of those companies are going to go zero as like they get copied and there's price competition that drives price and margin down. And so it's just interesting to me that like 90% of venture funds seem to be chasing the same vertical AI SaaS deals or AI SaaS deals. And I don't understand how that is defensible beyond like maybe people do secondary and some small funds make some money, but I think a lot of funds are going to lose their shirts. So that's why I invest in marketplaces with network effects and not pure SaaS.
Long live network effects.
Yes.
They are definitely not hot right now. Joe, you asked the question earlier of like why marketplaces aren't in vogue. I actually think network effects aren't in vogue right now. And I think much to the chagrin of probably some founders that build businesses right now. They'll probably learn the hard way.
Yeah. But it's crazy. If you look at how value's been created over time, I mean, the majority of the mega outcomes in venture have been companies with network effects.
Colin, I want to go back to something you said there about VCs trying to fit portfolio construction. I'm repackaging what you said, but essentially VCs trying to fit their portfolio construction model around what LPs want or what they think LPs want. And it reminds me of what I'd said earlier when we were talking about founders who are building a business that clearly should be oriented around network effects. Like that should be the core model. And they're trying to package it with subscription, even though it should be somehow transaction based or as frictionless as possible in order to spin the flywheel around the network effects. And I think in general, people should lean into what the actual strengths are and fit their model with what they deliver value around. So to go back to what you said, if you're a first-time manager, you don't have a lot of experience, or you have a lot of experience as an operator, maybe not so much as a picker, then don't be a picker. Don't go out and do a 15-company fund if you have a history as an operator. Like you're riding the lightning with that. It just doesn't make sense. So
yeah, I think I had an interesting epiphany / interaction. Like early stage funds, or sorry, like two things. When I say early stage funds, I think of like seed and pre-seed funds, right? And I think the earlier you go, the higher the dispersion of outcomes. And so the more you want to diversify. Hopefully that's not controversial. Maybe it is, but that's at least my take on it. And I think what is interesting is that if you take like the fund to fund model, a lot of them are the ones investing in emerging managers. They want a specific 15 to 30 company model, and they necessitate almost that you go early to get the valuation entry points that they need to make the math work. And so when you're an early stage fund, you're like, hey, or you're like a first time fund manager, you're looking at who's going to potentially fund you. You're like, those are the people. So like, yes, I kind of want to fit to what those like potential LPs look like. But I had an interaction with like Endowment Eddie on Twitter. I just like the thing that's great about Twitter or X is you can just go ask like amazing people for feedback on stuff and send them your investor updates, which I do is like everybody possible and get feedback. At the endowment level, which does much bigger checks, right, and need much bigger sizing, he was like, I actually get really worried if you're under 40 companies in a pre-seed fund. And I was like, wow, that is like just so different. I would not have expected that. I expected him or she or her to say what fund of funds were looking for, and they actually had a much different take on it. And so I think one thing I would say to first time managers is like, don't assume that the LP spectrum is all homogenous and what they want. And you really got to lean into what you're doing, like your strategy, and differentiate on that and just own it. Like, it's like, it is what it is. If people don't want to invest in it, that's great. It's actually a good signal for you. And you move on and you find the people that do.
And you don't want qualifying. Something else I learned during my fundraise, and I've learned from, I suppose, running in my own shop and talking to founders, on qualifying, you'll find that if you're a founder talking to VCs that say they do pre-seed and seed, or seed and Series A, the one that says pre-seed and seed, they usually mean seed. And they might mean pre-seed that really is more like seed, but you're calling it pre-seed, like me. That's me. But then you'll talk to people like, oh, we do seed and Series A. They do Series A. They really mean Series A. They might do like a small check and a seed for some optionality with an A, but they really mean an A. And to go to fund of funds, oh, we invest in emerging managers. They don't really mean fund 1. They mean fund 2, possibly fund 3. And just knowing who your audience is, I suppose, when you're out and qualifying allocators, investors, I think is pretty important. This has been really fun. I appreciate both of you coming on. For any founders out there who are listening who would like to have a conversation, what are the best ways for them to connect with you?
My email is always open. So it's just Sonia, SONIA, at SNAK.VC. So shoot me an email. Send me 1 or 2 sentences on why we are connecting and you're building a marketplace. I'm always happy to connect.
I literally the same as Sonia. It's just Colin at Yonder.VC. So I think my LinkedIn DMs are scary.
Yeah, don't go LinkedIn DM.
I will lose you.
Yeah.
I will lose you. And I feel like I publicly put out my email enough that if you just search my, you should find it. And yeah, I answer cold DMs or cold, emails.
Yeah, all the time.
Awesome. Well, thanks to you both and happy hunting in 2026.
Thanks, Joe.
You too.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai. And thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.